Good morning, everybody. Welcome to WORKSPACE year-end results. Thank you all for making the effort to be here this morning. As you all know, this is my first full year at the helm, and I think we've made some good progress in all areas throughout the last 12 months. Last year I set out a plan, and I think this year's results hopefully endorse that a lot of the decisions we made and the new strategy that we put in place is showing some fruits. There's a great energy and focus within WORKSPACE at the moment, and certainly I'd like to use this opportunity to thank the team within the business. Great support, great energy, great focus. And I'm also pleased to say that the momentum, the business momentum, has continued into this financial year, and we'll talk a little bit more about that later on. Just looking at the agenda, I will, as always, run through the year's highlights and the headline results, and then I'll hand over to Graham to go into some of the more of the performance, financial performance. I'll then pop back, and I want to talk a little bit about how I see this business, where it's going to go next, the direction, the momentum, because I think we're continuing to keep that momentum up through our hard work and efforts. And then obviously some time for questions at the end. So just one relatively backward-looking slide, and there's only one. But in preparation for today, I did actually look back at last year's presentation that I gave, and the closing statement I made about the business was as follows. I want to make sure that we're alive to all potential opportunities to add value, well known in our marketplace, and to communicate in a clear and open way with all of our stakeholders. Well, I guess you guys are all the best judge of that, but certainly for me, it feels like it's been a good year. We've transformed the way I think people look at the business. And just looking at the circle around the outside, we've repositioned the business, making it more clearly understood, more transparent, more open, and more active. We are currently repositioning the portfolio, making it more, focusing more on our strategic assets, focusing on modernising, refurbishing, and redevelopment assets where possible, and focusing on selling assets where appropriate, and that's something we set out last year. And we've also repositioned the balance sheet, a great effort last night from many, many people. We, along with the retail bond we closed last October, and obviously the financing we announced this morning, greater operational flexibility, longer term maturity profile, a much more diversified base of lenders, and all of our lending now is on a totally unsecured basis, which for us is a fantastic step forward. So whilst I personally are quite naturally cautious, and I think we are still in quite unstable times, I can't help but feel quite excited about the next 12 months for WORKSPACE, and I think we're very well positioned to grow. Turning to the results, probably going to break all rules of presenting, but I'm going to jump around a little bit. But I think one of the themes that I've followed throughout the year is very much the hard work pays. And I think this set of results really endorses that. And the two headline numbers for me are definitely the rent roll growth of 9% and the valuation growth of 8%. And just looking at the rent roll growth, driven by the operational momentum. So inquiries per month, year on year, up 3%. Occupancy now standing at 89.8%, and at the same time that we've been driving occupancy, we've also been driving pricing. Pricing now £13.75 a square foot, so 7% up. And it's easy to forget that is not just about new lettings. This is about actually monetising all of the energy from the whole of our tenant base. So a lot of that rent roll growth has actually come from rebasing rents from existing customers as well as new lettings. And I think that's important to remember, and we'll come on a little bit later to talk about that. Then looking at the valuation up 8%. I think the interesting point here, and I'm going to talk a little bit more later on, is that that's come majority from our efforts. We've had pretty flat yields across the year. So all of that valuation outperformance has come through, again, value add and driving the rents. NAV coming in at £3.48, which is a 13% increase. Trading profit settling at 17.9, which is a 12% increase. And that all amounted to us being able to announce a 10% increase in our dividend. So as I say, I'll come back in a minute and talk a little bit about direction and future growth. I'll just hand over to Graham to run through some more numbers.
Thank you, Jamie, and good morning, everyone. Just quickly to say, I think, as Jamie said, it's fair to say it's been a good year in a number of areas for the business. Looking first at the trading performance of the business, good growth in rental income, up 5%. If you strip out disposals, then actually the rental income was up 6% in the year. On the back of that, trading profit was up 12%, and that's enabled us to increase our dividend by 10% on a covered basis. So dividends covered just under 1.3 times by trading profits. From a balance sheet perspective, NAV up 13%. As Jamie said, that was on the back of an uplift in our revaluation of 8%, with yields going out 10 bips on our core like-for-like portfolio, so no benefit from any yield movement. And in terms of total property return, very pleased, total property return of a shade under 14% in the year. And from a finance perspective, a good stable base for the business, LTV at 40%, the average interest cost 5%. During the year, we completed the raising of money from a retail bond, and I'll come on to later the refinancing we announced this morning and the impact that will have on our overall financing. Looking at a bit more detail at the trading profit, the key driver of our trading profit is that like-for-like income. Like-for-like income, 3.4 million, that represented a 9% increase year on year in line with the rent roll growth. A slight drag on that overall growth, though, was the loss of income at the refurbishment redevelopment projects as we go through the cycle of actually refurbishing, redeveloping, albeit that we're now seeing some uplift in income from projects that are completed. So there was 0.3 million uplift in income from those projects that we completed during the year, and that will grow as we go forward. We made 6 disposals of non-core properties during the year, and that was reflected in a loss of income of 0.5 million. Against that, we had a 0.6 million uplift in our JV income during the year, and that reflected the fact that we've now fully vested the 100 million of that BlackRock joint venture. And in terms of that joint venture, we're very, very pleased with the performance of that joint venture. We now have 16 properties, yielding just over 7% on a rent roll basis, an uplift in the year in terms of the valuation of 5%. Admin expenses are up 0.8 million in the year, and that's due to the cost of our share-based incentives. If you strip out the uplift there, which is really linked to the performance of the shares in the market, then actually the underlying cost base was flat. And lastly, on interest cost marginally up by 0.2 million. The net debt was up by 14 million, but against that, our average interest cost had fell during the year from 5.1 to 5%. Just looking a little bit more at that like-for-like occupancy, and just reminding you, the like-for-like category represents the vast bulk of our properties. 80% of our properties are in this category, and they represent around 85% of our net rental income. So this is the key driver of our business. And what we're showing here is really that steady progression that we've seen pretty much over the last 3 years in terms of occupancy. But as we get to around 90%, as we've highlighted in the past, it does tend to flatten out if you look back at trends over previous cycles. Alongside that, we've had good growth in the rent roll. Rent roll was up 9% in the year, and that compared to a growth of rent roll of 5% last year. And the reason for that uplift this year was not only did we have the occupancy improvement, but as Jamie mentioned earlier, we've also seen good movement in pricing, that net rent per square foot. That rent per square foot was up 7% this year, and that compares to an increase on like-for-like portfolio of 3% last year. So quite a significant uplift in capturing uplift in pricing in this portfolio. Moving on to the other element of our trading performance around the refurbishment redevelopment projects. I've set out 2 pages here with quite a lot of details on them, with additional detail about the individual projects in the appendices. And I make no apologies for the amount of detail here because there is a lot going on. If we start first on the refurbishment projects, you'll see that we completed 4 of our projects during the year. They were completed to budget, and they're now letting up, and certainly pricing's ahead of our expectations, and we're very confident about achieving the future rent roll we see here of about approximately just over £1 million once we could get to about 90% occupancy. In addition, we've got 4 projects underway, 2 that will complete this year and 2 that will complete next year, in 2014. And again, they're running to plan, and we would expect, combined with those projects already completed, that in total, these projects completed underway would give us an uplift in rents of around £4.5 million at the pricing that we have today. That's not taking into account any uplift in pricing in the future. In addition, we've got 6 projects that are on the blocks with planning that we plan to start on a phased basis over the next year, and they will deliver new and upgraded space through 2014 and 2015. Again, potentially delivering quite a significant uplift in rental income. Moving on to the redevelopment projects, and you'll recall these are those projects where we're looking to unlock the residential potential at a number of our sites. At the half year, we announced 2 further redevelopments where we'd signed up with a residential development partner. So we now have 4 projects underway for 690 residential units. And on those 4 schemes, we will get back four lumps of business space. 2 of those projects were delivered in 2014 and 2 will deliver in 2015. And on top of that, we get 22 million of cash and overage on the residential component. And of that 22 million in cash, we actually received 11 million from the vacant possession we achieved at Bow in April. In addition, we've got 3 projects with planning now. Now, 2 of those we received the planning subsequent to the year end, so the uplift in valuation is not yet fully reflected in our NAV. The most significant of those is at Tower Bridge, where we have consent for 800 residential units. Obviously, we'll be talking to residential partners in the coming days. And lastly, we've got 5 projects which are at various stages of the planning process. And again, they will be delivering potentially in excess of 1,000 residential units. So there's an awful lot going on across our portfolio. And just to summarise on those projects that are completed underway, this is really just a sort of aggregation of what I've just talked through, is that excluding those at the design stage or going through planning, we can see if we can reach 90% occupancy at the current rents that we expect to achieve at these sites, an uplift in rents over the next 4 years of around £8 million. That's in addition to any growth we can achieve on our core like-for-like portfolio, if you recall the 45.5 million of rent roll we've got today. And this, of course, also excludes those other projects which are at the design and planning stage. In terms of the property valuation was up 70 million in the year. As I mentioned earlier, we did dispose of 6 properties. We've also accelerated our refurbishment programme, spending 30 million this year, up from 19 million in the previous year. In terms of the 8% uplift in the year and the revaluation surplus, that was split between the added value that we've delivered from the refurbishment redevelopment programme, which here I've highlighted around 24 million uplift in the year, and also that driving of rent performance at our core like-for-like properties, which has delivered us a 36 million uplift in the year. So as in previous years, we've got these 2 twin drivers of growth, that sort of redevelopment and refurbishment activity on one side and the driving of that core rental growth on the other. In terms of cash flow performance, we continue to see strong trading performance, no issues around any deterioration in our payment profile, and indeed our level of bad debt continues to be very low. Bad debts in the year were 0.3 million on our rent roll of 52 million. In terms of investment alongside the capital expenditure programme, as I mentioned earlier, we have now completed our investment in the BlackRock joint venture. And lastly, on financing, we did take advantage of the issue of our retail bond this year to pay down some of our near-term secured bank debt. Net debt increased from 314 million to 328 million pounds in the year. Moving on to the debt analysis, I've shown here the pro forma impact of the refinancing that we've announced today. What we've focused on here is a number of elements. Firstly, we've moved all our facilities from a secured to an unsecured basis. And this is very much something that we think is ideal for our business, gives us the operational flexibility to take advantage of the marketplace relatively quickly. Alongside that, we've extended the maturity of our debt by bringing in 4 major institutions on a longer term basis alongside our bank partners. And that's extending the maturity out to 7.8 years. We've also increased the quantum of our facilities by £27 million. So we've now got just over 80 million of headroom on our facilities. There is a small increase in the average interest cost on our debt, albeit that does include the cost on the revolver. And as we draw down that revolver, the overall average interest cost will come down. But what I would say here is I will update you once we complete the refinance on the 1st of July with our new hedging. But I have highlighted that potentially we will be cancelling up to 10 million of our existing hedges. In terms of the split of that new debt, we've got a good broad spread. We've got roughly a third now of bank debt, a third of private placement, a third of other funding. And I'm delighted to have brought in 4 UK and US institutions alongside our three banks and the retail bond. We've got a good broad spread of partners now, and it's great to see the enthusiasm of the banks and these long-term institutions in supporting the growth of Workspace. In terms of that maturity profile, we don't have any debt falling due before 2018 now, and we've got some good broad spread of debt out to 2023. I have to apologise that in the rush of completing last night, I have made a slight error, is that actually within 2023 debt, 22 million of that does actually fall due in 2022. So if in your note you could amend, it shows that we're all human, I'm afraid. And lastly, in terms of our balance sheet, net assets at the end of the year were £500 million. That reflected our increase in the valuation during the year. So NAV per share up from 3.08 to £3.48, driven by the uplift in the property valuation. Trading profit, obviously, the majority of that trading profit is used to underwrite the dividend. With that, I'll hand back to Jamie.
Thanks, Graham. So I guess the big question that everyone keeps asking me, we've had a good year, but what's next? I just want to talk a little bit about exactly that. I think we've got quite a few levers that we can pull, and set out some of these below on the slide here. And all of them we're able to pull really because of the box at the top. Again, intensive management, direct marketing, so our hands-on approach. We are not beholden to the marketplace for all of the value add, and we've shown that in this set of results. What I call over on the left-hand side, organic growth, just much more of the same. Driving the rent roll, driving the valuation. Our average rent per square foot is just under £13, capital value per square foot of 177. I think that is still quite a low base, and we've still got more to go for. So it's just a matter of working the machine, driving the rents and driving the values. And then over on the right-hand side, some of the new opportunities. We just run through these one by one. So new income. This is the refurbishment and redevelopment plan that Graham's just highlighted, and I think the scale of that is plain to see. And the reason it falls partly in organic and partly in new is because whilst we've already got the path set as to the assets we're already refurbishing, redeveloping, there are also lots more opportunities within the portfolio that are going to come up as we go forward. So that is something we can control and something that we can really drive value through with. Alternative income. Now, I know Workspace in the past, I think, has probably referenced that there are opportunities to drive revenue streams from customers, and maybe that was received poorly because it wasn't followed up. We're now actually making good money from these, and I think there's a lot more to go for here. And let me just tell you what I mean by this. In simple terms, this is making money from providing additional services and products to our customers. It's really a buy wholesale, sell retail strategy. And I think by prudent partnering, we can really make good money here. And not only that, we can provide services that are really value add to our customers, which in turn will make them pay more rent to us and stay in our buildings longer. Now, let me give you a real example, because I'm not someone who likes to talk about something we're going to do, something we're doing. So we did a partnership deal at the end of 2011 to provide some telecoms services into some of our key business centres. That now drives a profit to us of around £70,000 a month and is growing. And something like managed cloud services is an obvious next step for us in that arena. There are quite a lot of third-party organisations, government bodies who want access to our customers for data. We've got banks and equity providers who want to lend and invest to our customers. And we've got technology companies who are keen to capture market share and also promote new products. And I think because of the kind of customers we have, because they're all very similar, we have a very interesting opportunity to grow that income. Another example is Club Workspace. Now there's a brochure on your seat which sets out a little bit more information on Club Workspace. We are now the largest co-working platform across London, and again we are growing at quite a pace. Not only are we interacting with an incredibly new and exciting customer, we're driving revenue, but interestingly, we're also putting these things into space within our buildings that we're finding quite difficult to let, such as basements. They're very much a destination. So it's a kind of three-win strategy for us. Drive revenue, use space that we find difficult to let, and also capture another area of the market in terms of our customers. And we'll probably be talking more about this as we move forward, but I think it's quite an interesting opportunity for us over and above the core revenue streams that we have. And then acquisitions. I mean, we are very, very active at the moment looking to try and buy some assets. No stone is unturned. But unfortunately, well, not unfortunately, it's a matter of fact, it is very much a seller's market at the moment. And we have plenty of other levers to be pulling in the meantime, so we're in no rush. I don't want to make it be pressured into the wrong decision there. We know the kind of assets we like, we know the kind of prices we want to pay, so we need to hold our nerve and make sure whilst we're out there looking for everything, we feel comfortable with the kind of pricing that we're going to pay for any acquisitions. But that said, we've got 3 or 4 opportunities in our sights, very, very interesting, and I hope that we'll be talking more about driving the acquisition program as we move forward. So some interesting levers to pull, and again, the point I make at the top is really driven by the fact that it's our operational management that allows us access to some of these additional revenue streams, and also to drive the existing base. Now, slightly self-indulgent, but I just want to pick on 2 things which are both of quite close to me. The capital growth, or really the valuation. I've talked quite a lot about it openly, and parts of our portfolio I think are undervalued. And also I'd like to just touch on direct marketing. One of the things I set out last year to do, and we started doing that when we had our Capital Markets Day in October, is talk much more about how we run the business, how we interact with our customer. I'd just like to start on that path, and we'll be doing more of that throughout the year. But just looking at capital growth, or the valuation. So this is the IPD chart that we usually show. Our total return was 13.8%, so we dramatically outperformed IPD. We were first percentile IPD. But what I think is more interesting is that our performance, our 13.8, was made up 45% income growth, 55% capital growth. And if you then dial down to the capital growth, that capital growth came all through value add. In fact, our yields stay flat. In fact, what you'll see from this slide is that on the like-for-like portfolio, which is really where we're focusing our strategy, we drove our valuation 36 million. This time last year, that yield was 7.2%. So the yield has moved out. Now, I think that that is incorrect. Now, I've got to be careful. I've got to say, I think we're coming from a low base. But now we have started to break this portfolio down into chunks and be more open. That is mainly the large business centres in central London. And if you then look at the capital value per square foot overall, or even the capital value per square foot on the like-for-like, the base is quite low. So I guess the way I should articulate it is that I think we're coming off a low base. There's some other quite interesting messages on this slide. You can see from here, this is where we're gaining the valuation increases from our refurbishment redevelopment programme. So you can see that all of that valuation increase, as I mentioned earlier, is really coming from efforts rather than market movement. I think the other interesting message on here is that we did identify back in October when we broke the portfolio a group of properties that were not necessarily core to us, and we've called those the other portfolio. We've actually sold 13 million, and I class this category as either no growth or low growth. And I think the CBRE valuation highlights the point for us because it's actually going down in value. We've got another 8 million under offer, so I think we're getting to a point where we've sold off all the no growth, and we may be kept with the low growth. And they're mainly London industrials. We're very happy to own them. They're throwing off a 7.8% cash yield. We don't believe they're going down in value, and we will make sure we deal with them as and when we need to. But again, some quite interesting messages, both from a valuation point of view, where we're coming from today in terms of valuation growth, and also the fact that I think the properties we're looking to sell out of are the right ones for us to sell out of. I think the numbers show that. Switching gear to the other highlighted point, which I wanted to talk about, was direct marketing. And again, we'll talk more about this through the year. This, to me, is one of the biggest differentiators for us compared to the rest of the market. And it's easy to underestimate, actually, how important this is to us. And also, as we move forward, there's more and more focus on trying to capture customer market share, grabbing tenants in the we call TMT sector. And we've been directly marketing and interfacing with this group for many, many years now. And every day we are looking at trying to develop our strategy. It's very much a proactive strategy rather than a reactive strategy. We don't just have a website and a phone number. We're actually out searching out customers. 90% of our lettings are done in-house, so we're not reliant on third-party agents or intermediaries. 500,000 website visits, 14,000 phone calls. We've now got about 10,000 square feet of billboards across London with our new branding on, which is actually driving quite a lot of inquiry and interest. We're running customer events across our estate. They encourage both networking, into-trading. Quite a lot of our customers are now into-trading with each other. And also it gives us good information as to how these customers are actually working and operating within our business, within our buildings, and also within the communities they work in. And we're quite rare in that we do a customer survey. We do quite a lot of customer surveys, one full customer survey each year. And again, gives us critical feedback. We also do things like mystery shopping to make sure that we're training our marketing team correctly. Our marketing team runs right the way from our headquarters right the way through to site staff. So a real effort and focus on how we drive our marketing strategy, and something that I think is becoming more important. Why do we do it? Well, I think we've got a lot more to go for. And whether you label this marketplace as we do, new and growing companies, or the TMT sector, or SMEs, there's a lot more to go for. We've been talking to this marketplace directly for a long time, and we want to be the landlord of choice for that kind of customer. Just moving to the strategy, as I say, it's very much a proactive strategy. It's all about maximising market penetration. I put a few words down here that are modern in their field, but for example, we use heat mapping of our website, watching what people are doing on our website to make sure that we can drive our search engine optimization and our pay-per-click strategies, i.e. if someone is going on to words, if phrases, if someone is searching for space in London, we always need to be at the top of that list, and we do a lot of work to make sure we are. Tracking and follow-up. Let me give you an example. Anyone who inquires for space across our estate gets given a unique phone number. That's everyone gets given a unique phone number. So we can track whether they drop off straight away, we can call them back, we can watch what they do, where they go. And I think it's critical information for us. And then finally, the social media strategy. I mean, social media, especially with things like Club Workspace, is becoming a hugely important extension of marketing. So we will use social media to search out new communities of potential customers, and we'll infiltrate those communities and make sure they are then dragged over to our social media communities such as Club Workspace. And we've driven a lot of inquiries and a lot of transactions across our estate, particularly Club Workspace, by doing that. And we will dial that up as the months come by, because I think that'll become more and more important. I think the other important point is that a lot of our customers, that's the language they speak. A lot of it is the digital economy, so that's the way they actually work on a day-to-day basis. All sounds good. I think it's all a real differentiator for us. The main thing is it makes money and it gives us information. And I think in any marketplace, in any business, if you've got knowledge, that you can use that efficiently. But ultimately, this helps drive revenue streams for us. So that's pretty much us for the year. As I said right at the beginning, I want to reiterate, we do remain cautious because these times are unstable, but I think, speaking on behalf of the rest of the management team and the whole of Workspace, we can't help but feel quite excited about the next 12 months. The year has started well, momentum is continuing. We're active across the whole of London. We're in established locations as well as new, exciting and emerging locations across the capital. We interface directly with a modern, fast-growing, diverse customer base, and we're hands-on, working our portfolio as hard as we can on a daily basis to drive shareholder return. So I really do hope that the next 12 months will continue with the momentum that we've seen in these 12 months.